And we are going to talk about cost characteristics and the impact on the decision-making for managers, a general framework for making rational business decisions, capital expenditure decisions, compound interest and present value, tools for evaluating capital projects. Let's go see what's inside. Okay, so let's see. We know what sunk cost is, right? It's a historical amount expended already on a project previously. It's not relevant anymore to the current situation for making any decision. It's something that happened already, and you don't need to kind of think about it that much. Let's say you bought an equipment previously, it was very expensive, or it was not good, or okay, but that's past. It's a sunk cost. So what is the relevant cost for any manager to look at? It's important cost that it's relevant to the decision making. Items where future costs and revenues are expected to differ from the alternative decisions under consideration. So it's an important cost, dollar amount that you need to look at it very carefully. That's a relevant cost because it's gonna make make a difference. Okay, so here we have a case study. Let's see. Okay, I have to read the case study because otherwise we cannot follow it. So let's go one by one. During a recent ice storm, the company delivery truck was involved in a traffic accident. The truck originally cost $60,000 and was 40% depreciated already. An insurance company has provided the company $30,000 for the damages that were incurred. Company took the truck to a local dealer who offered two options. First, repair the truck for $24,000 or buy the truck as is for $10,000. Company has found an undamaged but otherwise identical used truck for sale on the internet for $32,000. What decisions are the best for this company? So the option one is to fix the truck for $24,000. They got already $30,000 from the insurance company, and or just they offered to buy the truck as is. And they got something just like that on internet, $32,000. Okay. The truck cost of $60,000 is a sunk cost and irrelevant. Yes, they bought it already for $60,000. That's not important. But the degree to which is depreciated is equally irrelevant also. 40% is already depreciated. That's fine. It has a book value at this point, and they have to consider what they want to do with this damaged truck already. The financial statement gain reported on sale is irrelevant. If they want to sell the truck, that's all okay. Let's say if they sell it for a gain or loss, but that's also irrelevant. The $30,000 received from the insurance is the same whether the truck is sold or repaired. So the truck either is sold or repaired. They got the $30,000 on the truck that has been damaged. So here is 60,000 and just 40% is depreciated. That means $24,000 is 40% of 60. That means $24,000 is depreciated so far, and the rest is not, but that's fine. So the truck book value is 60,000 minus 24. What is that? Let me calculate that. 60,000 minus 24. That's $36,000 book value, right? That's okay, but that has nothing to do right now with us in regards to decision making. So let's see. The $30,000 received from insurance is the same whether the truck is sold or repaired. So still same, because it does not vary between the two alternatives. It is irrelevant. It is not necessary to consider in the decision process. That's what it means when we say irrelevant. All that matters is that truck can be repaired for $24,000, which the company and the repair shop offered them, 24,000, or truck can be sold for 10,000. Those are two options. And the similar one purchased for 32. In the former case, the company is back in operation for $24,000. Here is $24,000. If they spend that, they will be, back to normal again. That's why it says if they spend $24,000, they will be back in operation. In the later, company is back in operation for $22,000, because if they buy one, it's $32,000 from internet, and if they sell the truck as is to the dealer, that will be $10,000 that dealer is giving them for this truck. So now the question is, do they want to spend $22,000, or do they want to spend $24,000 and fixing it? It seems clear that the better option is to sell the damaged truck and buy the one from internet and end up by $22,000, looks like, right? So you just look at the moving part instead of things that is going to happen no matter what. So the logic implied by the preceding decision is to focus on incremental items. Incremental items, those are the moving ones that I'm referring to. Things that is moving and is changing based on what you do. There are some stuff that is not going to change no matter what. Let's say they got $30,000 from the insurance company. That's not going to change. That is something constant. It's going to happen either way. So the logic implied by the preceding discussion is to focus on incremental items that differ between the alternatives. The same conclusion can be reached by a more comprehensive analysis of the cost and benefits. So let's look at it. Here says cost of damaged truck is $60,000. Accumulated depreciation is 40%, which is $24,000. Book value is $36,000. Insurance recovery is $30,000. So it's resulting reduced basis to $6,000. So the basis, because insurance company paid them $30,000, so that $30,000 insurance company payment will reduce the basis to all the way to $6,000. And then sales price of the damaged truck will be $10,000. And because $6,000 is the reduced basis, so they will have to recognize a gain of $4,000, and future depreciation purchase price of new truck will be based on the $32,000 the new truck they buy. So they sell the truck, they record $4,000 of gain, and they have a new truck now, $32,000 that they will depreciate it in future. Okay, so here is the income statement, which shows the $4,000 gain on the sale of truck, and future depreciation will be another $32,000 in future. And that means net impact on income will be $28,000 net impact to the income. So yes, they have a gain in here, but they have also $32,000 to depreciate in future. And that gives them a net impact on income of $28,000. And cash flow analysis for the truck, insurance company gave them $30,000, sales price is $40,000 to the repair shop, and purchase price of truck, the new truck on internet, similar truck, similar situation. So it's $32,000 new truck. So that gives net impact on cash flow of $8,000 net impact on cash. Here we have, again, the repair scenario. So if we have a truck for 60,000, depreciated for 24, and book value is 36, insurance gave us 30,000, so resulting in reduced basis will be $6,000, and we have to spend $24,000 to repair the truck, so resulting basis for the truck after repair will be $30,000, and future depreciation resulting basis will be also $30,000 to depreciate. In the regards to income analysis, we not going to have any gain or anything. We have future depreciation of only $30,000, and here was $28,000. So in future we will be able to depreciate for $30,000. In regards to cash flow, the insurance company gives us $30,000. We spent $24,000 to repair, and 30 minus 24, that gives us net impact on cash positive $6,000, which if you compare to purchase the sell the damaged truck and buy the used one from online, that gives us $8,000 positive. So as you see, again, the detailed analysis shows that there is $2,000 difference in the cash flow. Okay. Let's read this one. Relevant costs / benefits are rarely so obvious as illustrated for company in the example Delaware. Suppose the local truck dealer offered Delaware a third option, okay? And the third option is a $27,000 trade-in allowance towards a new truck costing $80,000. So it says, okay, we give you $20,000 trade-in allowance if you trade your damaged truck and buy a new one. The incremental cost of this option is $53,000 because we have to spend $80,000 and we have just trade-in allowance of $27,000, so that's $53,000 incremental cost. This is obviously more costly than either of the two options, because in the two options we were doing what? We were either spending $22,000 if we want to sell it to the repair shop and a dealer and buy one from internet, or the other one is $24,000 if we want to fix it. Okay, so here we have $53,000 increment, so it's almost more than double, right? But they're gonna get a new truck, so this is obviously more costly than either of the two options. But Delaware, we would have a brand new truck. As a result, Delaware must now begin to consider the other qualitative factors beyond those evident in the incremental cost analysis, because having a brand new truck has some benefits, as you know, right? This is often the case in business decision making. Rarely are two or more options under consideration driven only by quantifiable mathematics. That means it's not just simple numbers. There are some other issues that you need to consider. Okay, so we got that idea. So let's keep moving. Okay. Here is a picture, select most desirable option. So alternative A and alternative B and alternative. So you have several alternatives and you have to evaluate the qualitative analysis of relevant costs and benefits, whatever is relevant, okay? And qualitative factors, other factors that might be, changing your decision because of that. So it's just first analysis of relevant costs, but also the other factors. Let's look at outsourcing. Outsourcing is utilization of independent parties to manufacture products, sometimes known as make or buy, or manage data processing, tech support, payroll services, etc. You will see in other books also, it says make or buy. Make or buy or outsourcing is the same thing. So sometimes you are thinking, should I do the payroll in our company or have someone else to do the payroll for our company? Which one is better? Or if you have a product and there's a part inside that product, you are thinking, do we need to make the part ourselves, or it's just a better idea to buy the part from another company. So to understand that, obviously we need to get some numbers here. So let's go to this case study. So Pilot Corporation produces a software for handheld global positioning system, GPS. The software provides a robust tool for navigational support and mapping. It is used by airline pilots, mariners, and others. Because these applications are often of critical importance, pilot maintenance, tech support department that is available around the clock, answer questions. So it's a customer support service. The annual budget for the tech support department is shown below. They have direct labor, they have utilities and maintenance, building rent, phone expense, and annual depreciation of equipment. Total $635,360. Direct labor to staff the tech support department consists of 3 persons, always available during each 8-hour shift at an hourly rate of $12 per hour. So 3 person per shift times 3 shifts per day times 365 days times $12 per hour. That ends up to be $315,360. Okay, got it. The utilities and maintenance are fixed, but would be avoided if the units were shut down. The building is leased under a long-term contract and the rent is unavoidable. That's important. Sometimes you see a business that doesn't look, they are doing good, but they are still existing and they are still open. That's one reason, because most of the buildings are under a contract and the rent has to be paid no matter what until end of the contract. So that's why sometimes you see there are businesses around that don't look that they are busy, but you wonder why they are open still. That is the reason. So phone and computer equipment are leased under a flat rate contract, but the agreement is cancelable without penalty. Okay, that's good. The annual depreciation charge on furniture and fixture reflects a cost allocation of expenditures made in prior year. Okay, so that's something gonna happen no matter what. The annual depreciation charge on furniture and fixtures, those are costs that they spent prior years, and that's irrelevant. So let's keep going. Pilot has been approached by Chandra Corporation, a leading provider of independent tech support services, to provide a turnkey tech support solution at the rate of $12 per support event. Pilot estimates that it generates about 50,000 support events per year. Okay, so Chandra proposal to Pilot notes that the total expected cost of $600,000, which is 50,000 events times $12, is less than $635,360 currently budgeted for tech support. However, a correct analysis for pilot focuses only on the relevant items, and relevant items are things that it's very important. Let's say that rent, for example, that they have to pay. They cannot get rid of that rent. That's very important information you need to consider. And also the depreciation. Let's see what the book says anyway. So let's keep going. However, a correct analysis for pilot focuses only on the relevant items. Even if Chandra is engaged to provide the support service, building rent will continue to be incurred. And building rent is that one, $120,000. Okay. And annual depreciation will still happen no matter what. So it's continued to be incurred. So rent will be incurred. It's not relevant to the decision making because that rent will happen no matter what. So you have to take that out of the calculation. The cost of furniture and fixtures is a sunk cost. Happened before. It is not relevant to the decisions, and you need to take that furniture also out of your calculation of the cost. So the total cost of relevant items is much less than the $600,000 indicated by Chandra proposal. So therefore, the quantitative analysis suggests that pilot should continue to provide its own tech support in the near future. After all, why spend $600,000 to avoid $450,000 of cost? $415,000 comes from the only thing they can save by outsourcing is direct labor. They can save that. Utilities, they can save that. Those are two relevant information for this calculation. Building rent, it's important to know that you cannot get rid of it. So it's a matter that it's unavoidable. So you have to take this out of your cost calculation. Also, this one. So phone computer leasing, you can save that. So 40 plus 60, that's 100, plus 315, that's 415,360. That's all they can save, okay? So those are numbers that are important and relevant in this mathematical calculation. So 415,000 compared to 600,000 definitely is way below. It's better just to continue. However, once the building lease matures, when the furniture fixtures in need of replacement, or if the tech support volume drops off, Chandra's proposal might be worth in future to reconsider, okay? So here, again, building rent, as you see, it's unavoidable, so it's irrelevant. Annual depreciation is a sunk cost, irrelevant, and the rest is just 450. Okay, capacity issues. We are talking about opportunity cost. The cost of a foregone alternative may include lost revenue cost. That means, let's say you decide to go to college and get a degree. So the opportunity cost is the loss of income right now because you can work, but now you are going full-time as a student. So you have lost revenue and income from working somewhere else. So that's an opportunity cost. So let's read this case study so we know what we are doing. So Mueller Building System manufactures customized steel components that are sold in kits for the do-it-yourself rancher. The kit includes all of the parts necessary to easily construct metal barns of various shapes. Okay, the company products are very popular in US manufacturing plants, have been running from full capacity. Okay. In an effort to free up capacity, Mueller contracted with Zhang Manufacturing of China to produce all roof truss components to be included in the final kits. Okay, so a portion is going to be, giving to someone else in this, and see if we have any opportunity cost because of that. The capacity that was released now by the outsourcing decision enabled a 10% increase in the total number of kits that were produced and sold. So that's 10% increase in total number of kits because of that outsourcing. Mueller's accounting department prepared the following analysis that was used as a basis for negotiating the contract with them. So direct labor to produce trusses, that's 3.8 million. Direct material for trusses is 4 million. Variable factory overhead to produce the truss is 2 million, and avoidable fixed factory overhead to produce truss, that only 1 million avoidable. Okay, remember, fixed factory overhead you cannot avoid, but if there is any avoidable fixed cost, yes, that's relevant information. So here we have. So relevant cost to produce truss is 10,800,000. Contribution margin associated with 10% increase in kits production because of that outsourcing, we have $3 million increase in contribution margin because of having opportunity to increase the production by 10%. That's 3 million. So maximum amount to spend, including transportation for purchased trusses, is 13.8 million. They're not gonna, just go with but they want to spend less than this. So this is the maximum, but obviously they want to spend less. Okay, so let's see, qualitative issues. Yeah. So companies must be very careful to consider qualitative issues in making decisions about outsourcing. So it's an important matter, and they have to, spend some time on it to understand it perfectly. Outsourcing places quality control, production scheduling, and similar issues in the hands of third party, and that's nowadays might be a little bit risky issue, because if you have if you cannot control the scheduling and the quality and even transportation, those are things that, let's say something happens, like Suez Canal, it was closed a few years ago for some accident. So if there is some type of transportation issue, all of a sudden everything will become very complicated. So one must continually monitor the supplier's financial health and ability to continue to deliver quality products to a timely basis. If goods are being moved internationally, goods may be subject to high freight costs, custom fees, taxes, and other costs. Delays are often associated with the uncertain logistics of moving goods through brokers, large seaports, and homeland security inspections. And those are things that I was just referring to. Hopefully rare, but not to be ignored, are risks associated with relying on suppliers on politically unstable environment. Significant disruptions are not without precedent. So language barriers can be problematic. Although global trade is increasingly reliant on English, there are still many misuse of words that you have to understand between when you are communicating. Anyway, so we are good. Let's go to special order. Special order is a customer order that is outside of the normal pricing and terms. These special orders comes from someone out of your regular marketing area. So it's like one-time opportunity, and you want to know, you have to know how to deal with these special orders, because sometimes you can have an opportunity to make money out of nothing for just that moment. If you miss it, then it's gone forever. So other thing that in special order is important is to understand at what capacity you are you have a production right now. If you are below capacity, that relevant range of capacity of production, and you can take that special order, that's important. If you can do it without buying any new equipment or renting a new factory or investing anything, yes, that might be special order. With this, even a small profit still is better than nothing, since you are below your manufacturing capacity in your factory. So let's say this is an example. Assume that Lanker company produces the popular ripping rod Rogue. Okay, I don't know what that is, but anyway, the cost to produce a ripping Rogue is $10, consisting of 20 cents direct material, 40 cents direct labor, and 50 cents factory overhead. Okay, so material, labor, and overhead total $10. The overhead is 30% variable and 70% fixed cost allocation. So out of this overhead, 30% is variable, which is like 15 cents, and the rest, 35 cents, is fixed. Ripping Rogue are sold to retailers across the country through an established network of manufacturers representatives who are paid 10 cents for each lure sold in their respective territory. So, okay, commission is 10 cents. That's selling expense. Okay, variable selling expense. Lanker has been approached by another company to produce a special run of 1 million units. Okay. These lures would be sold under the Valley Wiggler brand name and would not otherwise compete. Oh, that's very important. Would not compete with sales of ripping Rogues. Okay, so that means these guys are going to sell this product with another brand name in another market, and it's not gonna be a competition or something. So Valley Pro Fishing Boards offer is priced at $1 per unit. Okay, $1 per unit. But remember, here we were talking about cost of $10, right? And they are offering you a $1 per unit. So in just first look, you say, oh, well, hell no, I'm not going to sell that for $1. My cost is $10, right? But you have to be a little bit more careful what your calculation is doing for you. So Lanker Lures is obligated to pay its representatives half of the normal rep fee for such private label transactions. Half of this 10 cents, which is 5 cents interest. They have to pay that. On the surface, it appears that Lanker Lures should not accept this order, as we just discussed. After all, the offer is priced below the noted cost of production, which is $10. However, so long as Valley's Wiggler do not compete with sales of ripping Rogue, and Lanker Lures has enough capacity, that's the word, enough capacity to produce, okay? Enough capacity. If you don't have enough capacity to produce, then the answer is no. But they have enough capacity. So that's the first thing you have to make sure. Without increasing fixed costs, like renting new place, buying new equipment or anything, or adding new labor or something like that. Profit will be enhanced by $200,000. Why? Because 20 cents, 1 million units produced, and 20 cents of leftover income after these sales. But let's see where this 20 cents is coming from. So selling price is $1. Okay, that's good. Direct material, it's 20 cents. Direct labor is 40 cents. And variable factory overhead is 15 cents, as I said before. So that's total variables are 75 cents variable. And manufacturing margin ends up to be 25 cents. Variable selling cost will be 50% of normal, which they were paying like 10 cents to representative. Now, because they are selling this to somewhere else as a private sale, they still have to give him to rep 5 cents for every unit sold in the private market. So that's 25 cents minus 5 cents to those reps. So still we have a contribution margin of 20 cents, okay? So by knowing the variable expenses, you can easily understand the actual contribution margin. And if the contribution margin is positive, so you can make some money here, as you see, $200,000. And also it's important to understand that you have enough capacity to produce, and you are currently producing below the capacity. So you have the capacity to increase another 1 million units. Sometimes there is a capacity constraints. That means there is a bottleneck somewhere, and that might be an issue. So let's read this to see what's going on. Potential error in special order pricing is acceptance of special order offering the highest contribution margin per dollar of sales while ignoring capacity constraint. Capacity constraint, that means you have, let's say, an equipment or a machine that has some capacity constraint, and you cannot produce more than that amount. Notice that the special order for Valley Wiggles offered a 20% contribution margin, which is 20 cents. Suppose Fishing Town also placed a special order for bass buzzer lure, and that special order offered a 30% margin on a $1 per unit selling price. At the first glance, we would assume that the Fishing Town order would represent better choice, but what if one were also informed that remaining plant capacity would all allow production of either 1 million Valley Wigglers or 600,000 bass buzzer? So because of the constraint in one of those equipments or machinery, so we can do another 1 million of Valley Wigglers or only 600 of buzzers. So let's do the math now. That the total contribution margin on the Wigglers is 200,000 if we do 1 million unit times 20 cents, while the contribution margin on buzzer will be $180,000 because we can go up to 600,000 units because of that capacity constraint. So you have to see just the higher contribution margin is not enough. You have to see what is your capacity of production. We got that. The other things also is discontinue a product or department. So here is a scenario that we have to look at. So let's see, read a little bit first. It is difficult to decide when to abandon a business unit or division that is performing poorly. Such decisions can have far-reaching effects on the company, shareholders, employees, suppliers, vendors. What analytical method should we employ to support a final decision? Okay, management should not merely conclude that a unit generating a net loss is to be eliminated. That's very important sentence. I like that. So just having a net loss at the bottom doesn't mean that unit needs to be eliminated. So be careful on that. This is an all too common error made by those who lack sufficient accounting knowledge. Sometimes eliminating a unit with a loss can actually reduce overall performance also. And I want you to look at this because this is normally what people do. It has a net loss and they eliminate it. Consider that some fixed costs identified with the discontinued unit may continue and must be absorbed by other units. This creates a potential domino effect where each failing unit pushes down the next. Instead, the appropriate analysis is to compare company-wide net income with and without the unit targeted for elimination. The Casa de Deportes, the company, is a mega sporting goods store occupying 80,000 square feet of space in a rented retailer. Each department is evaluated for profitability based on following information. So let's look at it a little bit. So we have fishing, hunting, camping, golf, and total. Variable expenses is given. Contribution margin for all of them are positive. You see? Okay. And then we have fixed cost. Okay. Those are fixed cost total. And net income for fishing is positive. For hunting is positive. For camping is positive. For golf is negative. So here you see the golf looks a little bit like, like a loser here, $30,000. Okay, so keep that in mind. For now, you see the golf is kind of an issue. Management is concerned about the golf department. If golf is discontinued, only 70% of the watch, you see here, only 70% of general and administrative costs would be eliminated. 70% of that. That means 210,000. Rent and depreciation would continue to be incurred because it's just a place. It's rented anyway, so it's not going to go anywhere. Equipment depreciation, furniture depreciation is going to happen no matter what. And utilities would be reduced by half only. So we can get rid of 70% of general administrative, and we can make utilities go, let's say, down by just 40, half of it, half of 40, which is 20. The unavoidable costs are shifted equally to the other departments, although other allocations method could be used. The overall conclusion would not change. The income report without golf appears as below. So there will be no income, obviously. There will be no contribution margin, everything zero. And the general administrative has to go to like 70%, you see, others, 210, $90,000 left goes to other departments, okay? 70% will be eliminated. The remaining $90,000 goes to other departments. So here, 630, 830, and 430. Selling expenses, okay, that will go away easily. That's selling expense because we are not selling it, so there is no selling expense. But rent will go also. It has to be paid, so the cost will be allocated to the other departments, so you cannot get rid of rent. Rent will stay. Utilities, half of it will go away. So half of utilities here, half of it, this is 20,000. 20,000 divided by 3, it will be added to the other departments. So that's like almost $6,666 added to every department. So utilities just half of it. Depreciation will happen no matter what. So the depreciation will be added here. So this, you see this depreciation of 40 will be allocated to the other departments for now. So that will happen no matter what. So as you see, the now all of a sudden the camping will start losing money if you do that. Here you had just $30,000 loss. Now everything was positive. Now all of a sudden it's a domino effect. Now the camping is also losing. So by eliminating golf, right, the net income here after elimination is 385,000, but before elimination was 755,000 total net income for the company. So as you see, it's a big issue. The contribution margin before elimination was 8.4 million, now is 7.2 million. So you cannot just by, eliminating loss division, thinking, oh, I'm going to fix the issues. No, you sometimes, most of the times, you even create bigger issues, as you see in here. Very good example. Okay. Let's move to next page, see what else is there. Okay, capital expenditure decisions, which is also known as capital budgeting, planning, and decision-making related to longer terms projects and expenditures. So it's very important for a manager to be familiar with capital expenditure decision-making and make a good decision in regards to what they want to buy and where they want to invest the company's resources in a new equipment or anything, or new company or new business or new factory building or anything else, or new equipment. So those are capital decision-making issues that you normally can use net present value calculation to do that. So time value of money, that is a conceptual notion holding that money to be received sooner is worth more than money to be received later. The example is if you ask a 3-4 years old kid, do you want $1 today or $1 next year? The kid will tell you, I want $1 today, because they know that $1 right now worth more than a $1 a year from now. The concept of time value of money. So compound interest, that means you get interest on the interest earned. And that's a very good way to have like in the saving account with a compounding interest, because you not only earn interest on your original dollar on the day one, but at the end of year one, you now have $10 and you earn more interest on $10. And at the end of year two, you earn interest on $21. And that's keep going. So the interest is compounding and earning interest on the interest of your investment. For future value of lump sum, this is where I told you can use the future value table, and future value table will give you the factors, which if you multiply that with the factor, then you can get that future value of dollar that you have in your let's say investment. So you are going to invest let's say $1 right now. What will be that $1 5 years from now? So it's a lump sum. Lump sum, that means just $1, not series of $1, just one time. And if you invest today, multiply with the factor, and then you can get the future value of that lump sum. Future value of that lump sum dollar amount. So this is not series of payment. So make sure you understand that this is just one time dollar amount. But if you have series of payment, then make sure you understand that's an annuities. Annuities is streams of level of series of equal payments, and that gives you annuity. Annuity can be annuity. Oh, here it can be annuity due, or it can be ordinary annuity. Annuity due means the first payment is due now, right now, in advance. But ordinary annuity means the series of payment, the payment comes at the end of the period. So there is different. The first payment will be now, it's annuity due. If the payment is at the end of the period, like end of the year or end of the month or end of the quarter, that will be annuity due. We talked about this already. And here is the ordinary annuity again. I just covered that. Ordinary annuity means the payment comes at the end of each year, not at the beginning. So here is the $5 at the end of each period. Okay, and that's why you have to look at the annuity table, ordinary annuity table, and this one is annuity due table. Those are two different tables. Either future value or present value, doesn't matter, but you have to look at those proper tables to get the factor. And present value is the present value of the dollar amount. It might be a lump sum. It might be annuity, series of payment. What's the present value of that? And for that, you have to look at the present value table. If it's just one-time payment, one amount, then you look at present value of $1. But if you look at the present value of series of payment, then you have to look at the proper table. Is it present value of annuity due, which is series of payment coming from the first payment due now, today, or in that case, you look at if it's payment coming from end of each period, so that's ordinary annuity. Again, present value of ordinary annuity table. So those are different tables that you have to be careful to look at them properly. So here is again talking about that present value calculation, which we covered in previous chapters already. You see this in this example, if you see the 100,000, it is at the end of see this 100,000 is it comes at the beginning of year 3, beginning of year 4, beginning of year 5. Because this is beginning of year 3, year 4, and year 5, you can calculate that at this point, like present value of annuity due, present value of annuity due. Okay, present value of annuity due, but that present value of annuity due will be at this point, at the end of year 2. Okay, so you stop right there. Present value of these 3 payments at beginning of year 3, beginning of year 4, and year 5 to bring it to present value of annuity due for 3 periods, annuity due. Okay, but this is not the final answer because you are in year 2. Now, in year 2, you calculate this lump sum, 285,941, and you bring it to the present value of lump sum to present value of today, right now. So 1, 2, 3 annuity due will combine, become a present value at beginning of year 3. And then that lump sum, or end of year 2, and then that lump sum will have to be calculated once again to bring it to the present value of today, based on I, interest rate for that market, and N2. So this is N, number of period is 2. Okay. Here was N3, I, interest rate, whatever it was. And now here is N2 this time, because here is year 2. However, this 700 is easy because this is lump sum at the end. And for that, you just calculate once. You just bring that for lump sum, present value of lump sum table, and you get the factor, and you multiply by $700,000. And then you add them up, and then you can get the present value of cash inflows of this scenario, whatever this scenario might be. If you read it, it might give you the information. So here is it's saying, assume that the real estate considering buying an office building, the building will be vacant for 2 years. You see 2 years, there's nothing coming up while it has been renovated. It is being renovated, then it will produce annual rents of 100,000 at the beginning of each of the next 3 years, here. So you bring it to the present value of annuity due, calculate that with the factor, and then use the present value of lump sum table to calculate it to present value of lump sum for 2 periods. And then 700,000 present value of lump sum for 5 periods, and then add them up, and that will be your present value of cash inflows. What's a good practice for present value calculation? We covered that present value when we were covering the bonds. So now let's look at the net present value. Net present value is one of the best ways to calculate and compare 2 alternatives or 3 alternatives or more, doesn't matter, of possible investment opportunities and make a good decision. So net present value, or NPV, is a method of evaluating capital projects that uses a predetermined interest rate, I, to determine the present value of an investment's net cash inflow and outflow. And that I, normally for every business might be different. Normally you can use weighted average cost of capital, WACC, WACC, or so-called hurdle rate, or so-called minimum required rate of return of a business to use in net present value calculation. Calculation of WACC, it's a finance type of thing if you are a finance major in future, but you can also look at WACC and look at Investopedia, and they have good videos on that. Weighted average cost of capital. Every business has a weighted average cost of capital, which is a combination of cost of borrowing plus cost of equity financing. Cost of borrowing is the interest rate that they need to pay, and cost of equity financing is the dividend that normally they pay to shareholders. Okay, so present value of table. Let's see if I can change the rate. the factors, let me go back to, I believe chapter 20, maybe chapter 24, I did it or no? Let's see. Yes, I have it here. Okay, so all the tables are here. So depends which table you want. And normally for net NPV, net present value, you use present value tables, either $1 ordinary annuity or present value of annuity due. But definitely present value of $1 will be one of the most used if it's lump sum. If it is annuity, you have to know which one you are using. Don't make a mistake. It's ordinary annuity. It means any series of payment comes at the end of each period. So you can go and over there get the factors. So here you see present value of cash flows, 575,000, 70,000, 70,000, 10,000, 10,000, 10,000. So you see those numbers are not same, right? So it's easier just to go ahead and use present value of lump sum table to calculate the factors. Factors for today is always 1, but factors for year 2, year 3, year 4 will be a little bit different. So this is based on interest rate of 5% here, 5%, okay? And just to show you where that is, let's say year 2, 0.952, where it's coming from. You go here, you go to present value of $1 table. And you can Google this also, present value tables, and you can easily find it on internet. So I is 5% here, and here is year 1, 0.95238, 0.95238. So here we go, 0.95238, right? And for year 2 is 90703, 90703, and just keep going down. You will have all the factors, multiply with the cash flow, and you get the dollar amount, add them up. That will be your total net present value. It will be the present value of this cash flow, okay? Present value of this cash flow, not net present value, but present value of the cash flow. And in order to calculate the net present value, then you have to look to see how much you're going to spend on this investment. Let's say this is the present value of cash flows, but let's say you let's say you spend let's say you spend $700,000 for this capital expenditure. So if you spend 700,000 minus 729,859, that gives you 29,859 positive net present value. Net present value, if it is 0 or positive, you will accept that project, that investment. So in order to accept the investment, the net present value should be at least 0 or positive number. So here the the present value of the cash flow is 729,000. If your, let's say, investment is 700,000 today, then 729 minus 700, that gives you $29,000 positive net present value, and you will accept the offer. So in this example, as you see, upfront purchase price of building is $575,000, but you have to remodel it for $60,000, the payable at the end of each year, and the present value of cash outflows is $729,000. So that $10,000 is the building taxes and insurance that needs to be paid. Okay, and they have they have to spend $575,000 to purchase it. They have to spend looks like $70,000, $60,000, but plus $10,000 for taxes and insurance. That will be 70. So 60 plus 10, 60 plus 10. That's during year 2, and that's 10,000, 10,000, 10,000. So you combine that, and the present value of cash outflows will be $729,829. And you have to compare this to a cash flow of $729. It gives you a positive net present value. This suggests that the project returns exceed a 5% cost of capital threshold. And what is the 5%? It is based on cost of capital for the company, which is weighted average cost of capital, hurdle rate, or minimum required rate of return. This is the minimum the company needs to produce in order to survive just paying the cost of the capital. Here it says, interesting, it says if instead of 575, if the initial purchase price of the building was 675, the project would have a negative net present value, and that would be not acceptable. Okay, and a negative net present value is not acceptable. It should be either 0 or positive. Okay. Okay, so let's keep going. Oh, changes in rates. Yeah, if the I is changing, the interest rate, then you have to use your calculation again. So let's read this, see what's going on. Okay. Carefully consider the mathematics, and yes, higher interest rate will produce lower present value factor, and vice versa. Okay, let's read this one. Consider that the Greenspan is considering a $500,000 investment that returns $128,000 at the end of each year for 5 years. The following spreadsheet shows how the net present value shifts from a positive net present value of $39,000 when interest rate is 6% to positive $11,000 when interest rate goes 8% to negative $14,000 when interest rate goes to 10%. That means the investment would make sense if the cost of capital was 6%, but not 10%. So if the interest rate goes up in the market, then so many capital expenditure will make no more sense, and that the companies will stop investing on those projects. And that's true when the market interest rate is going up by federal government. So here we have 6% interest rate, minimum required rate of return, hurdle rate, WACC, weighted average cost of capital. Cash flow is 500,000 today, negative, that's a minus. But in year 1 through 5, we get positive $128,000 cash flow. Multiply that with the present value of $1 table, one lump sum, and you can get, based on I6, you can get those factors and then add them up. Get the cash flows here. If you add them up, minus 500, add them up, minus 500, that gives you 39,000 net present value. So as you see, the net present value here is a positive number. But if it's 8%, still is positive, but smaller positive. But again, I said if it's 0 or positive, still is acceptable. But here in this scenario, by having a 10% interest rate, you have 14,000 minus 14,779, and that's not an acceptable situation. Okay, and the other thing that you can do instead of multiplying 128 by lump sum factor, present value of $1 table, like this many times, you can just multiply, because those are all same, you can use them as an annuity, ordinary annuity series of payment, and just multiply 128,000 by the annuity table present value, I6, and 5. So let me show you here, just you see. So go to present value of ordinary annuity, series of payment that comes at the end of each period. And you can easily go to I6 and go to N5. And the answer is, write it down, 4.21236. And then multiply that by $128,000 times 4.21236, and that ends up to be 55,391,8208. So that's 539,182. 539,182. If you go back to the book, yes, you see, you are spending 500,000 here minus 539,182, and that will be 39,182 or 183. And that will be your net present value. So instead of doing 5 times multiplication here, you can do just 1 time. And the only reason is because you have series of payment. Okay, let's read this one. On computing net present value, notice that the focus is on cash flows, not income. Items like depreciation do not impact the cash flows and are not included in the present value calculation. Yes, you use depreciation to deduct your income, pay less taxes, but you don't use depreciation to calculate your net present value, because you already here, you see in the $500,000 investment, you're already calculating it as a cost at once, right away, today. So there's no more depreciating anymore on that. That is why the illustration for Markham Real Estate did not include deductions for depreciation. However, when applying net present value consideration in practice, one must be well versed in tax effects. Some non-cash expenses like depreciation can reduce taxable income, which in turn reduces the amount of cash that must be paid for taxes. Therefore, cash inflows and outflows associated with particular investments should be carefully analyzed on an after-tax basis. This often entails the preparation of pro forma cash flow statement and consultation with professionals well versed in the details of specific tax rules. So here we have an income of, let's say, $40,000 net sales, less depreciation of 10,000. That gives us income tax before tax only 30,000, and that $30,000 times 30%, 35% tax rate will be 10,500. That means net income will be $19,500. So cash flow will be $40,000 from sales and tax of 10,500. So net cash flow will be $29,500. So let's read it. As a simple illustration, assume that Mirage Company purchased a tract of land with a prolific spring-fed creek. The land cost is $100,000, and $50,000 is spent to construct a water bottling facility. Net water sales amount to $40,000 per year. So 100 and 50,000 on water boiling facility. That's $150,000 investment. Net water sales amount to $40,000 per year. For simplicity, assume the amount is collected at the end of each year and is net of all cash expenses. Okay. The bottling plant has a 5-year life and is depreciated by the straight method. Recall that land is not depreciated, just the equipment. At the end of 5 years, it is anticipated that land will be sold for $100,000. Mirage has an 8% cost of capital and is subject to, so I is 8, okay? And subject to 35% tax rate on profit. The table shows the calculation of annual income and cash flows. The annual cash flow from water sales, not the net income, is incorporated into following spreadsheet. Here, the annual net cash flow are then multiplied by the appropriate present value factors corresponding to an 8% discount rate. The project has a positive net present value of $35,843. So let's look at the table. This is the land, purchase of land, $100,000, making a building on plant on it. And land never depreciate, but the plant will. So that's $150,000 net cash flow. Minus $150,000 cash flow today for this expenditure. And then we have $29,500 cash flow every year because of the net sales less expenses minus taxes. Times the factor, $1 present value of $1 one time lump sum based on I 8%. And that is, as you see, those are the dollar amounts. And if you add them up, minus 150, that gives you net present value of $35,843. So as you see, the amount of taxes that we paid has been considered after considering the depreciation. We don't put the depreciation in our calculation, but we use the depreciation to calculate the amount of tax that we might pay, and then that amount of tax will be used in our calculation. Accounting rate of return is a project evaluation tool that focuses on accounting income rather than cash flows. It's just like regular accounting income. What is regular accounting income? It's sales minus expenses gives you net income. So it's a project evaluation tool that focuses on accounting income rather than cash flows. Average annual increase in income by the amount of initial investment. So let's say this method divides the average annual increase in income by the amount of initial investment. That gives you accounting rate of return. One more time, this method divides the average annual increase in income because of that new investment by the amount of initial investment. That gives you a rate of return on an annual basis. For Mirage project, the accounting rate of return is 13%, which is $19,500 return on $150,000 income. Here, $19,500 net income return divided by total investment of 150. That gives you 13% accounting rate of return, okay? The accounting rate of return is simple and easy. The decision rule is to accept investment that exceeds a particular accounting rate of return, whatever the company has in mind. But the method ignores the time value of money, obviously. So it's nothing perfect, but it's good, you know, so. The duration of cash flows and terminal returns of investment dollars. So it's ignoring those stuff. As a result, by itself, the accounting rate of return can easily misidentify the best investment alternatives. It should be used with extreme care. But how about the internal rate of return? internal rate of return is also known as time adjusted rate of return, or IRR, discount rate, causing present value of cash inflows to equal present value of the cash outflows. So in order to find the internal rate of return, it's a little bit more complex than finding a present value, because you are going like backwards to find the internal rate of return. Let's see if do we have an example here. Yeah. So it needs a little bit try and error to find out what would be the proper interest rate to use in order to make the net present value 0. That means the initial outflow is 500,000, and then combination of present value of all these cash flows in the future adds up exactly or very close to 500,000 to make the net present value 0. And that will, it's necessary possibly for you to use, if you are doing a manual calculation, you use different interest rate. Let's say start from 5 and then 6 and then 7 and then 8 and 9, and to see where you are ending with a 0. So after doing this a little bit here and there, you will see that your internal rate of return is not 8%, because it's not 0. It's not 9% because again it's not 0, but it's somewhere in between, and you can kind of guess it's like 8.8 or something. But if you use Excel, then you can change the interest rate a little bit smaller amount till you get to the point that interest rate is somewhere very close to make this net present value 0. And then you know, okay, this project is providing me about 8.8% interest rate. And if that is bigger than minimum cost of capital, then you can probably accept that, because it's your weighted average cost of capital, let's say, is 6%, and this project gives you 8.8%. So then you say, yes, I will accept this. So that's internal rate of return for this project. Payback method is also good, but it's not perfect because it's not considering the present value calculation. It's just thinking it's an easy method for evaluating capital projects, calculated by dividing the initial investment by the annual cash flow. And that way you can calculate how fast this investment will pay back the initial investment. So let's say 500,000 initial investment divided by 128,000 annual cash flow, that gives us 3.9 years of initial 3.9 years of payback period. And if that 3.9 years is below management required payback period, then the project will be accepted. If it is above management expectation, then it will not be accepted because it's long. Let's say management say, I want everything to be paid within 3 years. So this project, because it's not paid by 3 years, is more than 3 years payback period, then it will not be accepted. If the management say, let's say my minimum payback period is 5 years, then 3.9 will be a good candidate. But again, payback period is not using present value method. There is a way to use the present value method for payback method and make it more sophisticated by first bringing all the cash flows to the present value, and then calculate the payback period, which that is in upper grade finance courses. Okay, that will be at the end of chapter 24. Hopefully you learned something, and please don't forget to take your final exam.